So the question is, what kind of implications does the current market have on your business, domestically and internationally? And why don't we start with Lawrence on that?
It's hard to tell what's going to be. It's very hard this time because it's the influence of the global implications will, until 3 weeks ago, was the rest of the global economy isolated from the US. Apparently it isn't. What a surprise. Is the consumer going to start spending? And remember, we've got three or four separate segments of business we're talking about for us. All have different implications to the economy. We've got the group business. Divide the group into two, associations and corporate. Divide corporate into two, finance and non-finance. Leisure, weekend leisure, then vacation leisure. FIT, corporate, non-corporate. So you've got, and each one is going to react very differently to the environment in a macro sense and in a geographical sense, because it's a different environment than we've operated in. You can say, well, the cycle is going to do this, supply is going to rescue us. Yes, it's true, but to maximize the benefit from the cycle, the chains have to be facile, as does the owners. The owners have to be much more facile with capital. So I think this is going to be a much more choppy environment, but for the small people, I think fortunes will be made in the next 18 months. Absolute fortunes.
I think Lawrence is right in many regards. We're looking at stats kind of real time that still feel pretty good. I mean, we heard yesterday, I guess, a number of people describing some of the stats, the real-time stats in the industry that feel good. I know looking at our portfolio, we haven't seen any real drop-off. January's been pretty good. We ended the year last year in a pretty strong way. Group bookings actually look extraordinarily strong vis-a-vis any kind of historical perspective. So you sit here and say, real time, we're feeling very good about things. Having said that, we all know we're on a lag, right? I mean, that our business historically in every cycle kind of lags the general economic cycle. I think it's fair to say that we didn't, well, I'm not an economist, that the economy is slowing. To what degree, recessionary, otherwise, I don't know, but it is certainly slowing. I think it'd be okay because banks, smaller regional banks are still lending. We're seeing amazingly little or no impact in our pipeline on the limited service side. Absolutely continue to kind of motor along and do quite well, which is very surprising. Around the globe, I think the big properties are probably going to be more likely to get done because there's still a fair amount of capital flow in other parts of the world. But inevitably, if this capital market scenario here gets worse, that probably is a little bit contagious with some of the big capital flows around the world, but probably less impacted. So, operationally, we're going to have some headwinds. I think from the standpoint of new development, particularly at the upper end, there just, in my opinion, have to be some headwinds based on what's going on in the broader capital markets.
I recognize that the capital markets actually will have an impact on supply, and the digestion of all this credit that Chris referenced is certainly something that has to clear the market. One of the interesting timing questions is if we do end up with results that start to slow in a quarter or two, what does that do to extend the time period for that credit to clear the market? So it may extend it out further. Hard to predict at this point, but that's one issue that you have to pay attention to. The second is that in selected markets, back to what Lawrence was saying, you have to look at each market, each customer base, and then each market separately. There are some things that you can note that are indicators. The first, I would say, is if you take a market like India, for example, the supply and demand is so mismatched at this point that it will take several years of increased supply in order for that to actually start to abate the growth that you're seeing in that market. There's really very modest new supply coming online. A lot is under construction, but just not open at this point. And demand continues to expand at a pretty significant clip.
The debt side has been a challenge. To get a loan over, say, $100 million is very difficult in this marketplace today. Lenders that are making loans that big, the few that are, will only do it if they pre-sell it. Typically, loans of that size, lenders will take it down, principal it, and then chop it up and sell it to other investors, including our group, that'll take the mezzanine position many times. But there are so few buyers now for that financing because in the past, companies would buy those up and roll them into CDOs out on Wall Street, and that whole business is dead. So the number of buyers of that is lower. And also banks have a lot of inventory, and they are reluctant to principal anything until they get that cleared. So there are a few deals out in the marketplace, but they are either deals that have already been, loans have been originated, and the lenders have got those, the inventory on the balance sheet, and we're looking to buy pieces of it. Or there are groups that are looking to finance a large portfolio, but the lenders are working with are trying to get buyers lined up for each tranche of debt before they'll actually commit to a borrower.